This video covers the application of overhead costs to jobs using a predetermined overhead rate, as well as calculating total job cost and unit cost within each job using this cost information. So let's finish off our previous example using the overhead rate we had calculated from our Pairco example. So just a quick refresher there. Our running Pairco example had a predetermined overhead rate of $4 per direct labor hour within their system. So to apply overhead in any case, we're going to take the predetermined overhead rate times the actual activity used or consumed or incurred by every particular job. So for example, if we have our job cost sheet for Pairco here, this job A143, we see that they used or had 8 direct labor hours associated with that job. So since our predetermined overhead rate in this system is $4 per direct labor hour, we're going to apply overhead at that rate of $4 per hour times the 8 direct labor hours that were associated with that job already. 8 times the $4 rate gives us total overhead cost assigned of $32. So now if we think about a running total of job costs here, we've got direct materials at $116. Direct labor at $120, and now this manufacturing overhead at $32. So LO3 was just to calculate the total cost and the unit product cost of any particular job, again using this idea of the plant-wide predetermined overhead rate. So with our Pairco example, our total cost of that job was just the sum of all those different manufacturing costs. 116 in direct materials, 120 in direct labor, 32 in manufacturing overhead, so a total cost of $268. Now if we want to come up with the unit product cost, we can look real quick and see that this job consists of 2 units, 2 of these cargo crates. So the unit cost would just be the total job cost, $268, divided by 2 units, or $134 per unit. Let's look at a quick example here. Job WR53 at Northwest Fab required $200 in direct materials, 10 direct labor hours at $15 per hour. Estimated total overhead for the year was $760,000, and estimated direct labor hours were 20,000. So assuming that direct labor hours is the allocation base for overhead, what would be recorded as the cost of job WR53? So pause this, work through that quick, and then I'll be back with an answer. So the cost of that job is $730. We know that the direct costs were being charged directly to it, so direct materials $200, direct labor $15 an hour times 10 hours, or $150, and now we just need that overhead applied or assigned. So first we have to come up with our predetermined overhead rate. We know that that's our estimated total overhead, $760,000, divided by our estimated allocation base, in this case the 20,000 direct labor hours, for a rate of $38 per direct labor hour. So to turn around an assigned overhead cost of this job, we've got the $38 per labor hour rate times the 10 direct labor hours already associated with that job for a total of $380. So then the total cost of the job becomes the sum of those 3 buckets. Materials of $200, labor of $150, overhead of $380, for a total of $730. So we want to think about a couple things from a managerial perspective, some potential sort of pitfalls, if you will, in these job order costing systems. So inaccurately assigning manufacturing costs to jobs certainly presents some problems in terms of planning decisions and operational decisions made by managers. It would also affect things like pricing decisions. We want to make sure we're building in enough profit. So job order costing systems can accurately trace direct costs to jobs, so all of our direct materials and our direct labor. Again, by nature of what these systems represent, very easy for us to associate those direct costs with jobs. But job order costing systems often fail, or at least come a little bit short, is maybe the better way to say it, to accurately allocate or assign all the overhead costs used during the production process to respective jobs. And really what we mean there is that, yes, we come up with the best allocation base we can, that should cause the incurrence or the driving of our costs, whether that's direct labor hours, machine hours, or whatever. But really, jobs don't use up resources on exactly that basis through our production process, right? It's very difficult for us to say that's a perfect correlation. It's a best effort, if that's a better way to think about it. So choosing an allocation base, again, very, very, very important, as we've already discussed about. Job order costing systems, when they're not properly implemented, when they have issues, it's often because they're using allocation bases that don't really reflect how jobs actually use or sort of consume these overhead resources. We want to make sure that we're picking that cost driver that really is the best cause and effect relationship between the increase in that cost driver, that allocation base, and an increase in overhead costs. That's going to be really the linchpin for accuracy in these types of systems. Now, a lot of companies do use a single predetermined plant-wide overhead rate to allocate all of their overhead costs to jobs. Sometimes, though, that's too simplistic. Sometimes that's going to be a source of potential errors or inaccuracies. If we have, for example, a very blended production process, we have a lot of machine or automation intensive sub-processes and a lot of manual or labor intensive processes, it becomes difficult to pick just one allocation base or cost driver. In other words, if we are using direct labor hours, we have all this automation as part of our process, the labor hour usage isn't really representing the incurrence of some of those costs driven by the more automated parts of the process. So if more than one cost driver can be identified, our job cost accuracy is potentially improved by using multiple predetermined overhead rates. And maybe we have those separated by department or by process or whatever. And we can segregate the automated stuff to use machine hours as an allocation base, and the more labor intensive or manual stuff to use the labor hours as an allocation base. Now, learning objective 4 was to compute the total cost and the unit product cost of a job using multiple predetermined overhead rates. And really, that's not a lot different than what we've already done, but just a couple extra considerations for us to keep in mind that I want to make sure we highlight. So let's take an example to start thinking about these things. Let's say Dixon Company has two departments, milling and assembly here. The company uses a job order costing system and computes predetermined overhead rates in each department separately. In the milling department, that's based on machine hours. That's a more automated process. And in assembly, it's based on direct labor hours. That's more manual. The company uses cost plus pricing and a markup of 75% of total cost to establish selling prices for all of its jobs. At the beginning of the year, we made the following estimates. So we can see that milling is very much more automation intensive, 60,000 machine hours, right, versus just 8,000 labor hours. Assembly is the reverse, 80,000 labor hours versus 3,000 machine hours. We also have the total fixed overhead cost estimated for each department, and then the estimated variable overhead per machine hour in the case of milling and per labor hour in the case of assembly. So during the current month, the company started and completed job 407. It wants to use its predetermined departmental overhead cost and rate for the milling and assembly departments to start determining this job cost. So the first thing we want to do is come up with the total estimated overhead for each department. And using our sort of mini cost formula, that's our fixed overhead plus all that variable overhead. So in milling, fixed was $390,000. To that, we're going to add the $2 per machine hour variable piece times the 60,000 estimated machine hours. I'm going to back up and just make sure we see that. So total fixed, $390, plus $2 in variable overhead cost times the 60,000 machine hours. Same idea for assembly. $500,000 in fixed overhead, plus $375 per labor hour in their case, times the 80,000 expected labor hours, for a total of 800,000. Again, fixed 500,000 plus labor hours of 80,000 times that estimated variable overhead piece, 375 per labor hour. There's our total estimated overhead in each department for the period. Then we can come up with predetermined overhead rates for each department. Total estimated overhead divided by that estimated allocation base or activity. In the case of milling, that's the 60,000 machine hours. In the case of assembly, that's the 80,000 labor hours. So total estimated overhead divided by total estimated allocation base gives us predetermined overhead rates of $8.50 per machine hour for milling and $10 per labor hour for assembly. So now we can come up with a cost for job 407 here. Now let's assume also, in addition to overhead costs, that job 407 has the following materials and labor costs: $870 in milling, respectively, and then $370 and $280 in assembly, respectively. So to apply overhead to this job 407, we're going to use those separate departmental overhead rates times the actual activity in each department for that allocation base in the department. So the milling department, let's start there. The predetermined overhead rate was $8.50 per machine hour. So we'll take the $8.50 times the 90 machine hours that this job 407 needed or used up in the milling department. And there's total assigned overhead of $765. Over here in assembly, we've got that predetermined overhead rate of $10 per labor hour from the previous slide, times the 20 labor hours that that job needed in assembly. 20 times 10, there's our $200 in allocated or assigned overhead costs. So let's figure out the total cost now of job 407. We've got the direct materials across both departments of $1170, the direct labor combined of $350, and now that overhead applied from just a minute ago of $965 in total across the two departments. That's a total cost then of the job of $2,485. Remember, when we say total cost of a job, we're talking about total manufacturing cost. So always the three buckets: direct materials, direct labor, and then that manufacturing overhead. Now, the selling price of job 407, we said to assume we're going to have a 75% total cost markup. So that total cost is $2,485. 75% of that is $1,863.75. So we'll just add that on top of the cost to get a selling price of $4,348.75. The cost plus pricing is fairly common in manufacturing settings for sure. It's also important to kind of realize or think about how using this departmental approach results in a different selling price for this job than would have been come up with or derived using a plant-wide rate based on either the labor hours or machine hours. Remember, we've got these two very different departments. One's very machine or automation intensive, one's very manual or labor intensive. So probably not appropriate to be using one single plant-wide rate. So the benefit, if you will, of using these separate departmental rates is they, at least in theory, provide a more accurate accounting of the costs that are consumed or used or caused by these jobs, which should make any kind of planning and decision making better going forward. We'll talk in Chapter 7 about activity-based costing, which comes up with predetermined overhead rates not by each department, but by each activity that's performed within the production process. So stay tuned for that. One last quick little bit here. The amount of overhead applied to jobs during the period, since we're basing this on this predetermined overhead rate, which itself is based on estimates from the beginning of the period, will likely be different than the actual amount of overhead cost incurred during the period. So in other words, we tabulate all the overhead we've applied to jobs using that predetermined overhead rate. It's probably not going to equal our receipts, if you will, for all these indirect costs like supervisory costs, property taxes, insurance, maintenance, utilities, and so on. So when a company applies less overhead than it actually incurs, we say that overhead was underapplied. If we applied more than we actually incurred, we'd say it was overapplied. Now, as we'll see in more detail in Chapter 3, we don't leave the overhead account with any kind of balance. That's got to be at zero. So what we do is adjust the overhead account, close it out to a cost of goods sold, most commonly, or divvy it up between cost of goods sold, work in process, and finished goods. Again, we'll get more to that in Chapter 3. For now, just want to think about the idea that We'll likely have this under or over applied overhead each period, and we're going to close that out to cost of goods sold, which could affect our net income for the period, right? The adjustment for under applied overhead would increase cost of goods sold, so that would in turn decrease net income, and the reverse would be true if we had over applied overhead. So we'll worry about accounting for that in the next chapter. So then think about this for a second. Does the occurrence of any under or over applied overhead suggest there's a problem with the current costing system? Pause the video, take a look at these potential responses, pick the one you think is best, and then resume and check your answer here. So the answer there is no. Since this overhead is applied based on our predetermined rates, which as we said are based on pre-period estimates, it'd certainly be common to have some difference between those estimates and our actual results. In fact, it would be quite rare, extremely rare, to have it be exactly, net zero at the end of the period. So that wraps up this video on applying overhead and coming up with total job costs and unit costs. Feel free to back up and review any portion you need to, and let me know if you have any questions.